When you hear the name Warren Buffett, I know you immediately think of the greatest investor in history. There simply isn't any area undiscussed or questions unanswered by Warren Buffett. However, I was able to find one single arena that stands out as Warren Buffett had not spoken about it. Did you guess it right? It's residential real estate. Even though many respected experts have warned about a bubble that is bound to implode in the coming years following the post-2020 boom, Charlie Munger and Warren Buffett have very much been quiet about it. Keep in mind that this boom made the prices spike by over 50%. With some deep digging, we were able to find answers, and what Warren actually thinks will keep you shocked. Before diving into this, you need to start with some background. During the real estate crash in 2007, average home prices dipped by over 28%, which made nationwide sentiment grow regarding the housing market as people and investors thought it was dying. Houses lost their status as value assets, and so the growth was rather sluggish. It was not until a decade later that a sudden rise occurred around 2017. This fired up the investor craze. In the pre-2020 period, a considerable portion of the general public showed a keen interest in residential real estate. This nationwide uptick in the interest for real estate investing is evident since it was merely a niche community with around 10,000 members, and by the end of 2021, it had grown over 1 million subscribers. The benefits presented by the residential real estate investments were reaped from individuals ranging from construction workers to accountants. The reason for this was that homes in the United States were relatively affordable compared to those in the rest of the developed world. And the most advantageous financial instrument, the 30-year mortgage, was in the United States. Low interest rates, surging prices, and ample opportunities for profit made it undeniable to resist investing in real estate. With all this excitement, something unexpected came around. In 2020, the entire economy became stagnant. Many had predicted a crash, while the exact opposite happened. Real estate experienced another surge, and the government brought down interest rates in an attempt to avoid a possible depression. From January 2019 to January 2021, the average 30-year rate in the United States plummeted from 4.45% to an astonishing 2.65%. To understand the depth better, look at this example. The monthly payment for a $500,000 house in today's market, with rates around 7.2%, is approximately $3,100. The same house with a 2.65% rate costs $2,000 a month. This is an effective 40% reduction. Now, you may be wondering where Warren Buffett comes in. Hang tight, you'll be hearing from him shortly. Let's wrap up this background story before diving into his insights. The real estate market went through a major transformation during the post-2020 developments, where home prices soared beyond expectations. From January 2020 to the present day, the Case-Shiller Index has gone up by 47%. This is the industry standard for measuring average home prices in the country. The fortunate few were able to receive a substantial increase in their paper net worth, while the delayed portion faced even more hardships as prices became unmanageable and continued to soar. Even now, rates are exceeding recent averages, which gives minimal hope for the average American to enter the housing market. The biggest question right now for buyers is if home ownership is still a worthwhile investment, and if they should continue to consider it a financial asset. Prices are only bound to go down, with the median payment now hovering around $2,500 a month. The best consultation for this issue would be Warren Buffett. Information about regular houses cannot be found that much in Warren Buffett's statements, but I was able to piece together a few clips regarding the American housing market to shed light on his philosophy. This is a clip from an interview back in 2012. Take a listen.
If I had a way of buying a couple 100,000 single-family homes and had a way of managing, the management is enormous. It was really a problem because they're one by one. They're not like apartment houses. But I would load up on them, and I would take mortgages out at very, very low rates. But if anybody is thinking about buying homes, 5 years ago they couldn't buy them fast enough because they thought they were going to go up, and now they don't buy them because they think they're going to go down, and interest rates are far lower. It's a way, in effect, to short the dollar, because you can take a 30-year mortgage, and if it turns out your interest rate's too high next week, you refinance lower, and if it turns out it's too low, the other guy's stuck with it for 30 years. So it's a very attractive asset class now.
If you are a young individual investor at home and you have your choice between buying your first home or investing in stocks, where would you tell someone is the better bet?
If I thought I was going to live, if I knew where I was going to want to live the next 5 or 10 years, I would buy a home and I'd finance it with a 30-year mortgage, and it's a terrific deal. And if I was an investor that was a handy type, which I'm not, and I could buy a couple of them at distressed prices, and find renters, I think that's, and again, take a 30-year mortgage. It's a leveraged way of owning a very cheap asset now, and no, I think that's probably as an attractive an investment.
You saw how Warren Buffett was completely positive about housing, even saying he'd buy when the market crashed and homes were at an all-time low. During this time, the Vegas Case-Shiller was at 89, which grew up to 20,084 nearly 12 years later, a 29% increase. Imagine if Warren would have said the same thing today with the price escalation in mind. It's quite sure that investing in American homes is a defining path towards owning riches. This is because the U.S. has the best deal, a 30-year fixed-rate mortgage. This fact alone makes investments in the housing market an attractive opportunity. Here's something interesting. Imagine you're the world's most unfortunate real estate investor. You already have a home and are looking into buying another property for renting out. This would be the summer of '06, and imagine you decide to invest in the worst inflated market, and that would be Las Vegas. Now that we know what unfolded in the following years, investing in this exact time period would surely be the worst decision ever. This area was hit the hardest in the U.S. To emphasize this example, think that you actually rented out a house from this area during possibly the worst time. There will be certain assumptions made during this calculation. However, I did find various sources indicating an average rent of around $900. The assumption made was that a good 3-bedroom home, which would cost $315,000 at that time, would be for at least $1,250. Go ahead and share your thoughts in the comments if you disagree. However, I aimed for a fair estimate. Moreover, maintenance cost, closing costs, and a 5% vacancy rate was added to this evaluation to make it more realistic. Now, these results would take you by surprise. I know what you might be thinking, investing in the worst possible time in the least favorable locations in the U.S. Now, here's what's going to surprise you. A real estate investor who had invested in this situation would still have earned a 26% cash-on-cash return. This assumes that you don't refinance at any point for a lesser rate. Say it went south. Even so, you'd still secure at least an honorable return. Fun fact is that if the owner holds on to the property for even longer, the returns would be even higher. Moral of the story is that if you're a patient and responsible person, losing money is going to be pretty hard. So this is why investing during a much more reasonable time or a less explosive city would help you reap much bigger results. With the low down payment requirements, this sector is a good choice to invest in. As you would know, Buffett is not a big fan of this strategy simply because it won't work out in his business scale. This entire strategy goes out the window. The reason Buffett is not in the single-family home sector is because it won't make money at a level that he's looking to do. And add to that the legal issues and public image issues he'd have to deal with in the corporate level trying to implement such a strategy. In this next clip, he explains exactly this.
What do you think of the good old single-family dwelling as an investment these days?
I said a year ago that I thought it was a very good investment for people that knew that they were going to live in that locale for a considerable period of time, found the house they liked, then I told them to take out a very, very long-term mortgage. And I would say the same thing today. It's not quite as attractive as it was a year ago, but it's still an attractive holding, but only if you're going to keep it for a long time.
Now you might be thinking why everybody doesn't have an investment home and print money. So let me show you the other side of the coin. People like Dave Ramsey are against home investment unless you're buying with cash, is simply because it brings financial risk to your life. Borrowing money means you're entering a leverage position, and if things go bad, you'll be facing all sorts of issues. Throughout the video, I talked about how to make money in the worst possible situations. However, I still didn't show you how this could go wrong in a dozen ways, especially if you're buying multiple homes and using excessive leverage to establish this strategy. Things could go wrong. Imagine other reasons like divorce, health problems, legal issues, or a job loss that will put their entire strategy at risk. These situations may have a low probability rate, but it's not zero, and once the payments stop flowing to you, bankruptcy follows suit. It's hard to determine who's right or wrong, and very much debatable whether home investment is as great as it sounds. I hope this video was eye-opening and thought-provoking, and don't forget to let me know what you think in the comments below. Do you agree with the Dave argument or the Buffett argument? As always, please make sure you hit that like and subscribe button if you enjoyed it.